pleased to be here today for the half-year economic and fiscal update and the budget policy statement. We just want to first of all review where the New Zealand economy is up to, despite significant challenges faced by many other countries. New Zealand economy has continued to grow in 2013. In fact, since the lowest point of the recession, which is the June quarter 2009, the New Zealand economy has grown by an average of 2% real GDP per year. We remain on track to surplus in 2014-15, although it will still be a challenge to actually reach surplus in that financial year. Just to remind you of the government's plan that we outlined a couple of budgets ago, which is focused on more jobs and increasing incomes. First, to responsibly manage the government's finances. That means running a tight ship well beyond 2014-15 when we achieve surplus. Secondly, pushing ahead with a cohesive program of microeconomic reforms, and these are all set out in the business growth agenda, focusing on building our domestic competitiveness for our businesses because we have direct control over that. Thirdly, getting better results for New Zealanders and better value for money out of our public services. And success here is measured on what we achieve for our communities and our families, not by how much money we are spending. And finally, supporting the rebuild of Christchurch, where the government contribution remains at around $15 billion. We'll just have a look through the Treasury forecasts. As you can see from the figures, economies continue to expand, growing 2.5% over the year to June, despite the headwinds of a pretty severe drought in the first half that affected the economy in the first half of 2013. And the signs, I think, are now pretty evident that growth has picked up appreciably in the second half of this year. So the half-year update shows the economy growing by 3.6% in the year to March 2015. But that improving economy also comes with risks. And we know the shape of these risks because we saw them playing out through the mid-2000s when sharp increases in house prices and large increases in government spending drove up interest rates, and the exchange rate, or certainly lent pressure to drive up interest and exchange rates. That pushed our export sector into recession in early 2000. In 2007, before the global financial crisis, and created pretty significant imbalances in the economy, which still need to be corrected. The Reserve Bank has signalled pretty clearly that it's expecting to start increasing interest rates sometime next year. So we will be focusing on the labour, skills and resource constraints that might limit New Zealand's economic capacity and therefore lead to inflation pressures and further pressure on interest and exchange rates. So the government has taken steps already, in fact beginning 2 or 3 years ago, to manage the risks that go with this cycle. So we've been on a pretty long run program to help ease supply pressures around housing, and that's now swinging to action with the announcement of several thousand further houses and subdivisions in Auckland just in the last couple of days, and also putting in place the building blocks of sustainable, responsible fiscal policy where we manage our finances by focusing on doing a better job of providing services and supporting New Zealanders and their families and communities. We're doing a bit better than most other developed countries, and it's been one of the policy challenges, particularly for our Reserve Bank, where the performance of the economy is pushing them in the direction of increasing interest rates at a time when 3/4 of world output is in economies with interest rates between 0 and 1%. And that includes economies in the Euro area, the US, United Kingdom, Japan and Canada. We expect our growth rate to be a bit better than Australia, but their forecast will be announced later today with their mid-year update. Global factors will continue to affect New Zealand, which makes up just 1/4 of 1% of the world economy, and the Secretary of the Treasury has taken you through some of those external risks. I would particularly draw your attention to the uncertainties that will inevitably arise around the withdrawal of monetary stimulus in the US, Europe and Japan, 3 of the world's largest 4 economies. And part of that is the effect on the high Kiwi dollar, largely a factor of offshore weakness that the Secretary of the Treasury talked about. That has been, as we've explained before, a significant headwind in rebalancing this economy towards the export sector. The current account deficit, just bear in mind these forecasts were completed before the revision by Department of Stats of our current account measures. And for instance, those measures reduce the current account for the year to March 2013 to 3.9% from what's on this graph at 4.5%. So they're reasonably significant reductions, but they occurred after Treasury closed off its economic forecasts. So the graph here includes, even including the impact of the rebuild, the current account looks considerably better than the mid to late 2000s when it actually reached 8% of GDP. And part of New Zealand's challenge as it manages the next growth cycle is to see whether the microeconomic reforms that have been made, the shifts in terms of trade, will mean we can get through the next cycle without a current account deficit reaching 8 or 9%, and the early signs are reasonably good. The statistics revisions are largely due to now counting higher earnings from tourists spending in New Zealand, which then means less allocated to domestic consumption, which means higher national savings rates. So it's just another positive change in the measures, which might reinforce the message that it's actually possible for New Zealand to improve its current account position. We spent some time talking about rebalancing the economy in the longer term, helping businesses become more competitive so they can invest particularly in the export sector and grow off earning from the rest of the world. All those policy changes are outlined in detail in the business growth agenda with which you may be familiar. Our trade and investment relationships with Asia are of course growing, in some cases pretty rapidly, and Australia, despite some uncertainty about its short-term economic outlook, remains one of the stronger performing developed economies and our largest trading partner. Since mid-2009, around the bottom of the recession, New Zealand's tradable sector has grown by 11.1% after it stagnated between 2005 and 2009. The non-tradable sector has grown by just slightly more than half that, at 6.6%. However, this will require the continued rebalancing will require ongoing fiscal prudence and continued microeconomic reform. Would also be greatly helped if the US economy can get up and moving and our exchange rate against the US dollar reduce. Unemployment is forecast to fall. I think it's a tribute to the New Zealand labour market and New Zealand businesses that they found their way through a difficult recession without some of the peaks of unemployment that were experienced in other developed countries. But we'll have to continue to work pretty hard to support job growth. So the half-year forecasts show the labour market improving, with the unemployment rate currently at 6.2%, falling below 6% in 2014-15. We'd like to do better than that. There's a number of factors supporting the labour market at the moment, such as a relative quite high participation rate, certainly higher than Australia, 2 or 3 percentage points, and also the shift in migration patterns, which means that total employment is growing and unemployment is dropping just a bit more slowly than you might expect. Over the past year, around 53,000 more New Zealanders gained employment. In actual numbers, Treasury forecasts that the number of people in employment, as measured by the HLFS, will increase by 125,000 between September 2013 quarter, which we've just had, and March quarter 2017. Household disposable income has increased by over 8% in real terms in the last 4 years, and is forecast to increase by around 10% over the next 4 years. And the government will continue to focus on more jobs and higher incomes. We remain on track to surplus at $86 million in 2014-15. You would describe the surplus as not the largest one that's been reported by a government. We also remain on track to meet the targets of getting core Crown debt, net core Crown debt, below 20% of GDP by 2020. We're on track to reduce core Crown expenses to around 30% of GDP by 2015-16. As the yellow line on the graph shows, when we became government in 2008, the spending was forecast to be around 35% of GDP. Now, over the last 5 years, we've taken a pretty sensible approach to understanding the main drivers of that spending and getting them under control. The main drivers of that spending are often the community experience of social failure, of crime, welfare dependency, educational failure, and that's where we have brought into focus results the government is trying to achieve, and we believe that's now flowing through to better results for taxpayers' money. The budget policy statement confirms operating allowances of $1 billion for budget 2014. As the Secretary of the Treasury pointed out, there's announcements today that effectively shrink the government's debt program that was announced back in the budget. Net debt is now forecast to peak at 26.5% of GDP and was forecast as recently as budget this year to peak at 28.7% of GDP. So the forecast has dropped debt by 2 percentage points. You may recall 4 or 5 years ago we effectively set a ceiling of around 30% of GDP, so we're going to come in well under that. Over the next few budgets we'll use existing capital from the government's balance sheet to finance new capital investments, mainly driven by reinvesting the proceeds of the government's share offer program through the Future Investment Fund. And as we announced a week or two ago, Treasury's revised the assumption of the share sale receipts to 4.6 to 5 billion. It's well worth being aware of the dollar value of debt the government has run up in recent years, driven to a large extent by the revenue impact of the global financial crisis and the Canterbury earthquakes. So here are the dollar value, which was around 10 billion in 2008. It's now expected to peak at 65 billion. At the budget, we forecast debt to peak at 70 billion in June 2017. So it'll peak lower and it will peak earlier. So on current forecasts, we plan to start repaying debt in 2016-17, a year earlier than forecast at the last budget. The forecasts have improved largely because of good performance in 2012-13 and the indications of further good fiscal performance in the current financial year. We will still be borrowing at a net $78 million per week this year. But of course, without the significant efforts by thousands of public servants to provide more for less, that number would have been much higher. Which brings me to the focus on public services. We set out 5 years ago to improve public services at the same time as manage government expenditure, and to focus on improving the drivers of long-term performance of our public services. And that's, you've seen the government focus, for instance, on boosting frontline services and reducing back office functions. And this has all been in the context of taking a longer view. At least one measure of whether it's succeeding is the fiscal measure. A second one is the Kiwi Count survey, which shows a steady increase in overall user satisfaction with public services, improving from a score of 68% in 2007 to 73% in 2013. That is a tribute to the motivation and professionalism of our public servants. A third measure is that we're also making progress towards achieving the results we published last year, and which are updated regularly so that people can hold the government to account over whether taxpayers' funding is having an impact on changing their communities. So there's details here around NCA pass rates, 2010 67%, 2 years later 77%. Strong focus on rehabilitation of prisoners who are being released because they cost $90,000 a year to house. There are nearly 2,000 fewer offenders returning to the prison system in 12-13 than 2 years previously. So that's where we get the fiscal gains and the ability to manage other cost increases. Expected MSD welfare costs are down by around $700 million in the forecasts published today over the next 4 years. This is in part due to an improved outlook for the economy and the labour market, but also active support from MSD, where we've had a particular impact on a reduction in the number of sole parents on job seeker and sole parent support. So looking out beyond 2014-15, we're confident that the New Zealand economy can continue to make real progress. In fact, the key to that progress is sustained focus on building the confidence of businesses to invest more and employ more people, and supporting higher paying jobs with higher levels of capital investment. We're looking out beyond the next 2 or 3 years to ensure that this fiscal and economic momentum can endure, and make sure that New Zealand has choices for our future now that we have weathered one of the deeper recessions in a couple of generations. We need to build our buffer against future shocks. The Treasury forecasts don't include future forecasts of recession, but we do know there will be one at some stage in the next decade. This means consistently running cash surpluses and giving us the choices of repaying debt, which I've indicated can now start a year earlier, resuming contributions to the super fund, which can also start a year earlier than indicated in the last budget. Secure services also give us some choices around investing in effective public services to improve the quality and results from those services, and reduce future costs for taxpayers. That's at the heart of the investment approach that's being applied to welfare. All of this will require us to continue with pretty considered fiscal management. That sits in the context of the wider task of managing the upswing in the New Zealand economy. We know from the experience of the mid-2000s that strength in this economy also comes with risks, and if those risks eventuate, we pay later after we've enjoyed the benefits of some growth. Pressures on inflation and the exchange rate and interest rates from the strengthening of the economy and the demands of the Canterbury rebuild all need to be managed to the extent that we can. What we do know is that if we add to this cycle with unmanaged increases in government spending and ongoing persistent increases in house prices, then the consequences are quite predictable. A higher exchange rate and interest rate track, and an export sector that suffers, and then another cycle of government and the community having to repair the damage done during an unmanaged boom. So the budget next year will pick up on these themes and develop them further. Any questions?
Mr. English,